Big news for the housing market this week. The Fed finally cut rates for the first time in over a year, but it was Powell's words that shook up the market. Rates dipped, then bounced right back as the 10-year Treasury yield jumped. Mortgage applications are surging. Searches for help with mortgage have reached levels that we have not seen since 2008. So what does this all mean for buyers and sellers? Let's break it down. But the big news this week, as expected, the Fed cut its benchmark rate down by 25 basis points or a quarter point, and they are signaling 2 more cuts that could be coming later this year. That puts the Fed funds rate between 4 and 4.25%. Now, a lot of people think that Fed cuts means that mortgage rates are going to continue to fall, but that's not exactly how it works. So here's the nuance. Mortgage rates follow the 10-year Treasury yield in rather lockstep fashion, and they also follow investor expectations, not necessarily the Fed directly. So right after the Fed rate cut, which took place on Wednesday, September 17th, you can see that we immediately started to see the 10-year Treasury yield dip. It actually fell just under 4%. But when Powell started talking, you can see it spiked right back up intraday, and that caused mortgage rates to bounce slightly higher by the end of day, and we have actually continued to follow that trend as we close out the week here. Of course, the overall big picture is still pretty positive here. Mortgage rates have trended down. The national average for a 30-year fixed rate mortgage today is sitting in the lower 6% range, and rates have fallen from nearly 7% where they were just a few months ago. So for the median home buyer, that's worth about 25 grand in extra purchasing power compared to where we were just midsummer. Now, the lower rates are causing mortgage demand to have its biggest surge since 2021. Overall applications jumped nearly 30% in a single week, but refinance activity was the star, soaring 58% week over week and up over 70% compared to the same time last year. And even purchase applications were up modestly at 3%. Hitting some of the best levels that we've seen since 2023. But of course, the catch here is that right after this report came out, mortgage rates spiked again on the Fed announcement and the economic data. So this burst of activity may lose a little bit of steam if rates don't stabilize. Shifting gears slightly, Redfin's latest report shows that home prices are climbing again. The median sales price is just over $392,000. That is up 2.2% year on year. This is the biggest increase in 5 months. So even with the mortgage rates being higher here over the last year or two, prices have continued to climb. The average monthly mortgage payment is sitting at $2,590 per month. This is just about exactly where we were the same time in 2023, still near the lowest point of the year, but they kicked up slightly because prices are rising even though rates have come down. Pending home sales are up only 0.8% compared to last year, which confirms the buy-side demand is still a little soft. New listings are up 1% year over year. They barely budged, but as you can see here, they seem to be following the rather seasonal trend here as we close out the year. Overall housing inventory is up about 10% year on year. That puts us at about 4.5 months of supply. And for those that don't know how this chart works, it means that essentially if no other homes were to hit the market, it would take 4.5 months to sell everything that's currently listed for sale. So you can see that the inventory is up. We're seeing slightly more homes for sale than we have in the past few years, which is good. It does mean that buyers have slightly more to choose from and they can be a little bit more selective. According to a Redfin agent, it definitely feels more like a buyer's market here. If they are not priced and presented well from the outset, many homes are sitting on the market longer than usual and many sellers are open to concessions. A lot of buyers are waiting for interest rates to drop further before making offers. The problem with this strategy is that if rates do fall again, more buyers will come off the sidelines, prices will rise, and sellers will regain their leverage. That means even with lower mortgage rates, buyers could end up with a higher monthly payment. Now check this out, very interesting chart here. Google searches for the phrase help with mortgage have now spiked to levels that we haven't seen back since 2008. This essentially tells us 2 important things here in my view. First, a lot of homeowners are feeling squeezed right now. This doesn't necessarily have to be just because of the mortgage rate. Many home buyers, I think 90% of homeowners rather, are locked into rates that are below 5%. However, we are seeing the rising cost of home ownership across the board in things like property taxes, insurance, maintenance, the costs for those have all skyrocketed. And secondly, it's a reminder that even though mortgage rates have improved, affordability is still front and center for many households. And this could be one of the stronger signals that housing is in a very delicate spot right now. And it just goes to show that mortgage rates matter, but so do jobs, so does inflation, and the overall economic confidence. All right, and to wrap things up, buyers actually do have some leverage right now. That's the good news if you're a potential home buyer in today's market. Homes that aren't priced right and presented well, they are sitting a lot of times 60 days plus, which means that sellers are going to be more willing to negotiate price and terms. So whether that's reducing the price, offering closing cost credits, rate buy downs, or other concessions, you do have a little bit more negotiating power. For sellers, this means that strategy matters now more than ever. If your home is not priced competitively, or it doesn't show well, it's likely going to sit on the market. But if you nail the pricing and you nail the presentation, you can actually still move relatively quickly in today's market. And here's what could be a big risk for buyers that are waiting on the sidelines, hoping that mortgage rates continue to fall. If rates drop, more buyers could come off the sidelines, flood the market, sellers regain their leverage, competition ramps up, and even with the lower mortgage rates, the monthly payment, which is what most buyers actually solve to, might not improve because prices will rise. So here's what I would suggest for potential buyers in today's market, and this is not like earth-shattering stuff here, it's just the basics. One, go ahead and get pre-qualified now so you're ready. Two, look at homes that have been sitting on the market 60 plus days. A lot of times the seller is going to be a lot more open to negotiating on price and terms. And three, get with the local professional who really understands the market and is not afraid to put in the work for you. That means touring properties, making offers, and putting you in the optimal position to buy right, borrow smart, and build wealth. That's all I have for you today. Don't forget to like and subscribe. Take care. We'll see you next week.